A rip-roaring rally today after the market selling off following the Fed. What are we going to make of all this? That's why we're bringing in Jim Welsh of Macro Tides. Jim, I mean, this is a crazy week, right? I mean, we had the
Yep.
Fed. I want to get your input here, but here we are 2 days later. After the stock market sold off, dollar rallied, and then we're getting the opposite because maybe it's quadruple witching today. I mean, tell us what's going on in your view, in your own words. How'd you see the Fed, and what do you make of this market reaction?
I thought the Fed was going to be a bit more hawkish. Yes, they would cut by 25 basis points, but that they would use the Summary of Economic Projections, which is the SEP, to communicate how many cuts they were projecting for next year. At the September meeting, it was 4 cuts. What I wrote in Monday's weekly technical review was I thought that we would see the mixture, if you will, between doves and hawks. First of all, agree on that cut after a spirited debate, and it sounds like that's exactly what took place. But I thought there was a chance that we would see more than one cut, or yeah, more than one cut reduced for next year. In other words, instead of 4 cuts, something less than three. I did not fully expect that they would go all the way to two. So there was a decided shift, Blake, in terms of some of the hawks looking for no cuts next year, and even some of the doves dialing back from how many cuts they were expecting. So that's why you saw it go from 4 to 2. The thing I would point out again is the Fed is historically really wrong about all these things. So, back in 21, as we were going into 22, hey, we're only going to raise the funds rate 3 times. Well, that was 75 basis points to over 400. Powell thought inflation was going to be transitory in 2022. That didn't prove to be the case. So I just think that we're in an area as far as the economy, government policy that is so uncertain that we need to take some of what the Fed wrote down with a grain of salt. But that said, the fact that they took away 2 cuts is what the markets responded to.
Now, the I mean, didn't they have every right to? I mean, I'm asking just because
Sure.
the data has been solid. I mean, but the data has been solid, but you have been pointing out that there's things that you're seeing that might suggest that the economy is slowing, but that's been the case for a while. So is this justified, or maybe maybe they're just not looking at some of the metrics you're looking at?
No, I think 2 things. First of all, if you're going to give forward guidance, you're going to go on, you're going to make decisions based on the data that's visible to everyone else. So they're going to do that in part, and because inflation's ticked higher, which I thought it was going to do during the fourth quarter. And I think they just felt that, okay, they want to keep inflation expectations under control. They believe that by talking tough and giving a tough appearance in terms of, yeah, we're really going to get inflation down, that will keep inflation expectations under control. So I think, again, the Fed is going to rely on the data as it's presented to them. Yes, do they look at some of this stuff that maybe is under the surface? I mean, Powell referenced that when they revised the job growth. Remember, a few months ago, job growth got revised down by over 100,000. Well, he mentioned that, so that it's not like they don't pay attention to it. Blake, I just think that they feel that things had gotten to a point where they needed to show we're drawing a line. Now, it really comes down to if I'm right and the data hasn't been really as strong, and we're going to cover a couple of those things in a few minutes, the shift to hawkishness sets up the Fed for potentially then pulling back. If indeed data comes in softer, then they can do that. And again, no one knows exactly what's going to happen with all the Trump proposals. Is there a risk that inflation could heat up more? Absolutely. Given the tariffs. Will the economy stay as strong? We don't know. I think it's more likely given the disruption. I mean, basically what Trump is proposing is a big disruption to the way things have been done in Washington for a very long time. And even if all those things turn out to be positive, when you're going through the phase of disruption, there's a lot of outcomes that at any point in time in the middle of that process, gee, maybe this is not going to turn out as well as we thought. He's going to get resistance from trading partners, from the Dems, and even some Republicans. And I think we're seeing that playing out already, Blake, in terms of the continuing resolution, brouhaha that's taken place. And now we're on the verge of a government shutdown. So I think though all those things kind of have come together to make people become more cautious prior to today's rebound. And I think you're right. The quadruple expiration, I think played a role in some of the weakness. And I think potentially as positions get rolled, we're seeing that play out in the strength today in the S&P.
Yeah, well, it's definitely strong today, and we're recovering a lot from what we lost a couple of days ago.
Yeah. Yeah.
You brought some charts, so let's go into your
Yeah.
SEP. Let's start off with that chart and
Yep.
get into it.
So the thing I just want to point out, this is the summary of economic projections that the Fed members provide every 3 months. So the last one was September. This is the one for December. The next one will come in March. And the thing I'm highlighting here is, first of all, they think the economy is going to be okay. So that in 2025, they think the unemployment rate will be 4.3 instead of 4.4, which is what they estimated. And you skipped forward, Blake, by the way.
What? Oh, I did. Oh, I'm
You
sorry, I
did,
didn't.
man.
Oh, here it is. Sorry about that. My
Blake is
fault.
Blake wants to get to the weekend ASAP. So, all right. So the point being is, we think the economy is going to be good enough so that unemployment might tick down from the 4.4 that we estimated in September to 4.3. Then here's the biggest change. In September, they thought the headline PCE, Personal Consumption Expenditures Index, which is the Fed's more preferred inflation metric, they ticked it up from 2.1 to 2.5 and the core up to 2.5 from 2.2. And I think this is what got people's attention is like, this adds credibility to the idea that they won't be cutting rates anytime soon. So what this tells us, I think, is the Fed is going to have to have evidence that inflation is coming down, as we discussed last week. That evidence is going to show up, in my view, as we get into April or January, February, March, and April. The takeaway values on the CPI, Blake, from 2023 for those 4 months is 1.4%. If the CPI goes up by 0.25% month over month in those 4 months, that means the CPI is going to drop by 0.4. Plus the shelter thing is going to help out as well. So my point being is they've set the bar, and I think the bar, as we get evidence that, you know what, inflation may come down more than what they're talking about. I mean, again, they're talking about 2.5 by the end of next year. If we start to see evidence that things are improving as we get towards the spring, I think the markets will conclude, wait a second, there's going to be more room for a cut down the road. So this is why the markets reacted the way they did. The biggest thing was the economy is going to be okay, but more importantly, inflation is going to tick higher in a meaningful way. At least that's what they're projecting.
All right, Jim. Well, appreciate you bringing that up and explaining us what they're looking at as far as the SEP goes.
Yeah.
So this is employment growth. Explain to us what you're looking at here.
Okay. So the Philadelphia Fed uses employment data from the states, and they go through these, and these are after revisions have been made. So this is maybe more accurate data. And so from October 1st of 2023 through the second quarter, June 30th, what the Philly Fed found was that instead of job growth averaging 1.6%, which is what the BLS reported, every month in terms of job growth, well, the Philly Fed says, no, that was probably closer to zero point 0.8. So again, we saw that the Fed said, well, the unemployment rate's going to tick down next year. And most economists are of the mind that, hey, the labor market's really good. So here is a revision that got, I would say, very little. Certainly didn't get the headline that the monthly jobs report did, But this suggests, Blake, that the labor market is significantly weaker than what we thought it was. And I think as we move forward, just like this data came out, like, oh, wait a second, that window of time was much weaker than we thought. I think the same thing is going to happen as we move forward. But it's going to take time for that to show up.
But th these types of things have been showing up for a while, Jim, and we haven't seen it happen yet. I mean, and we're coming into a Trump presidency where,
Yeah,
people, there's a lot of optimism out there. There's probably a
there is.
resurgence in hiring at this point. So do you think that maybe this leading indicator is just going to revert?
No, I
Okay.
don't.
All right.
Okay. And we're going to get to, there's a chart we're going to show, which again underscores how much government spending has taken place. We know for this whole year, but starting in October, the number is ridiculous. So let's go to the next chart
Okay.
because the next chart is looking at shelter. So this is important. So the CPI, the core CPI, I think was 3.3 and the headline was maybe 2.7. And shelter comprises 40% of the CPI. So we're seeing for the first time some meaningful declines in owner's equivalent rent and rent itself.
Yeah.
And my point being is that these have, it's 18% of the PCE, so it's not completely insignificant, but in the CPI. So my point is we know there's big takeaways coming in the next 4 months. Again, December could also be another month where not much progress is made. But as we get into the first 4 months of next year, you're taking away 1.4%. I think inflation isn't going to be ratcheting up early next year. And shelter is going to be one of those components that will help that happen and could actually bring it down a touch relative to where it's been like the last 3 to 6 months. So this is what's coming. It's just not here yet. The Fed just raised the bar in terms of, oh my God, inflation is a big problem. They've just increased their estimates. Well, that sets the markets up for a reaction if indeed inflation starts to come down as we get into next year. And it'll take off the idea that, oh my God, the Fed won't cut rates. So the combination of the labor market being a little weaker already and inflation improving, I think, that the Fed projections aren't going to be realized. And again, I underscore, David Rosenberg went back many years to look at the projections in the SEP. They were only right one-third of the time. So I'm not talking about something like, wow, these guys are excellent at doing this. It's a really tough task. And they get it wrong. And yet
Yeah.
most people put a great deal of emphasis on these projections. And so for me, it's like, okay, let's look at some other things to see if what they're saying is likely to be borne out. I think there's reason to think or question it as we go, especially through the first few months of next year.
Okay, and so this PCE as the rents and equivalent rents come down, it's going to bring in some deflationary pressures. But do you think that's going to help the economy?
Well, again, we're seeing the annual changes in these costs coming down. Are people who are paying rent going to see their rent come down? No.
Okay,
It's just the way the numbers are. I mean, it's very
the way the
unlikely.
numbers are going to fall and the way
Now,
that
in
they're
some markets, you may see some softening in rents because there was a huge increase in the number of apartments built over the last 2 years. And obviously, that's not spread evenly across the country. There's some regions where more was built relative to the demand. But overall, I don't think, and I talked about this. I think one of the risks to the Trump presidency is a lot of people who have traditionally voted Democratic went for him. And what made up their mind wasn't any of this fancy stuff. It's just in their mind, my budget and my, cost of living and everything was better when he was president than the last few years. And he says he's going to bring inflation down, and that would be good. And that's why they voted. My point, I think it's going to be really difficult to actually bring inflation down. In other words, your rent went up by 40%. Is it coming down by 5 or 10% in the next 2 years? Probably not. That means the midterm elections, Blake, could really be problematic for being able to follow through on some of the policies that Trump is going to attempt to initiate
Yeah.
next year or in 2 years because people are going to be like, geez, I voted for the guy and he said he was going to help me and I don't see a whole lot of help. I mean, eggs went up 54%. My wife bakes an enormous amount of cookies. Every Christmas, she'll make more than 4,000 cookies. All
Oh
right.
my gosh.
And I go shopping with her. So the price of eggs a few weeks ago was five and a half a dozen. This week, $7 a dozen of eggs. Well, guess what? That hurts a lot of families who are trying to stretch a budget. And that's what they're seeing. So my point is Trump is going to try to do some stuff. There's going to be some real challenges in terms of the average person on the street. It's just like, hey, is my cost of living actually gone down? And in 2 years, if that hasn't happened, I think the Republicans easily could lose the House. And now we're
Well,
back to stalemate. So we'll see.
yeah. And probably, with this next chart, you're talking about government spending. I mean, this is you would think this is going to change, right?
Yes. And that's my point in terms of two things. Why has the economy held up so well? We'll look at the escalation in government spending over the last 12 months and then look in October. So here's what the Biden administration did, Blake, is during September, they cut back on some spending because they wanted the annual budget. Remember, the government's year ends September 30th. So they wanted to make the budget not look so bad, the deficit for 2024. So they kind of flatlined spending and then they blew it out in October. And of course, look at the trajectory is still pretty aggressively up. So they were trying to do whatever they could to give the economy a positive jolt. And I think they succeeded. GDP is still growing around 3%, but to your point, and I believe, and I mentioned this last week, Trump's Treasury nominee, Scott Bessent, he wants to cut the deficit from 6%, it was 6.4%, by the way, last year, to 3%. In other words, let's cut it from 2 trillion down to 1 trillion. Well, if they succeed in doing that, is that going to give the economy a lift or weigh on growth?
Right.
And I think, again, as people realize and start doing the numbers in their head, as far as, geez, that's not going to be supportive. And the idea of cutting regulation, is it important? Yes. Is that going to translate to immediate growth to offset the cutback in spending? I don't think so, because business people have been through this before. You go through one administration, okay, they're cutting regulation. But we know that can change if the other team gets in, which it did. Biden passed more regulation than any president ever. And so as a businessman, are you going to plan that, okay, Trump cuts regulation? Am I going to rush out and do a bunch of spending? Think about the oil companies. Okay, he wants them to increase spending. We talked about this briefly last week. But, if you know that Trump could lose the next election, the Republicans could potentially lose, and all of a sudden, if Dems get in, they're going to do what Biden did, which was very anti-fossil fuels. So you're going to, okay, President Trump asked me to do this. I'm going to do it, knowing that this is really on thin ice. Plus, you've got shareholders that are very happy that you've been buying back stock and increasing your dividends.
Yeah.
So Trump wants to bring inflation down. He touted bringing energy prices down. Well, the oil industry has a reason why they're going to be resistant to that. So these are all the realities I think that are going to kick in. And one of them is going to be the growth in government spending is going to slow. That's going to have a negative impact on economic growth. Not
Yeah,
rocket.
that's so true. That's so true. Well, Jim, I want to see how you expect it to react to markets. So, I mean, here's the dollar.
Yep.
And this is it looks like you got an analog from 2017.
Well, I mentioned this, and then this chart showed up, and so I was like, okay, hey, this is great. Because what I mentioned was the dollar last week peaked in January of 2017 as Trump took office, and then it subsequently had a fairly decent sized pullback over the next, I think, 13 months. I think the price pattern was implying that we were nearing a top in the dollar index and that Trump actually favors a weaker dollar, not a stronger dollar. Everybody thinks his policies are going to result in a stronger dollar. Well, if they cut government spending and the economy slows, is the dollar going to react favorably to that? Uh, we'll find out. So I just thought this was interesting in terms of, hey, look at this is what happened the last time he came into office. And as he expressed views about a weaker dollar and not minding if the dollar weakened, as he did in 2017, I think, traders are going to jump on. Mr. President Trump, just tell me which way you want me to bet. Oh, you'd like to see it go down? Happy to oblige.
Right, right. That's going to be like, well, I mean, I guess the question I've had, and I'll just maybe talk to you a little bit about this, is what can, how, I mean, based on his policies, and you think about tariffs and some of the policies that he wants to employ, how is he going to engineer a weaker dollar, Jim?
All he has to do is say he'd like to see, or say like he did in 2017, dollar's too strong. That's all he's got to say.
Yeah.
Why? Because money is going to move. And what I wrote about in the December macro tides is I went through a deep dive. If you go back the last 40 years, what has been the thing that pushed the dollar up and down more than any other issue? Trade deficit, interest rates, economic relative performance between the US and other countries. It was the mindset of the administration. And, in the 90s, Clinton's guy, Robert Rubin, strong dollars in the best interests of the US. Dollar did well.
Yeah.
Reagan, it went up when he got president, and then in '85 they did the Plaza Accord or something. I can't remember. I might have that. I know the term. In early '85, they all agreed to lower the dollar. The dollar
That
went
was the
from
Plaza Accord, I believe. Yeah.
yes, 164. That's where it was in 1985. And by 1987, it was below 90.
Right.
Okay. So my point, and President Bush from 2001 to 8, his administration didn't favor a strong dollar. His Treasury Secretary made some comments, and the dollar went down from 121, I believe, in 2002 to in 2008, it got down to 70. Now, there were a lot of other stuff that went on, but so my point is, people are assuming, Blake, that his policies are automatically going to cause the dollar to go up. That's why it's been going up the last 2, 3 months. That's why people are positioned for the dollar to go up even more. They're already in. So anyway, and
So the
I would,
dollar's on shaky ground as it is. And this is going to be your chart to really talk about that because
yeah,
you've been talking about us completing your Elliott wave pattern up at these levels, somewhere up here
yeah,
soon, whether it's here
yeah.
now or not, we'll see.
Yeah. So again, going back, you can't see on the left side, but the dollar peaked in October of 22 at 114.70 something, right? And then it dropped to 99, 15 points decline. And that bottomed, I can't remember which month it was. But anyway, big
Uh
ABC,
yeah.
and then this C wave. And as we've talked, at the low around 100, I thought, okay, we're going to rally. Initially it was, well, maybe we'll get to 103, then 104 and a half. And then as this thing evolved, it's like, whoa, okay, this is what the pattern looks like now. 5 up. The last few weeks, the talk, as we've talked, it's like, I think there's one more move up. The dollar will get above 108.07. On Monday's report, I said, I think if the Fed adopts a more hawkish tone, that could be the rationale for the dollar to have this pop above 108.07. And, so far that's unfolded.
Yeah.
And so, to me, this is the zip code to be looking for the dollar to top. And because we're going into year end, currencies have a tendency to, peak or reach an intermediate turning point right before year end or right after. So what I said last week is I think as we go into the next few weeks, the top will be in place. And if this pattern analysis is correct, the next move for the dollar is down 15 points. In other words, a decline just about equal to what we saw off the original high at 114 and change. That brings it down under 95 over
Yeah.
the next, by early 26 would be my guess.
Now you say we're within the zip code. I mean, the question is, is this the high, or do we stretch even further from here?
It could go a little bit more.
Yeah.
108.99 was one other price target measurement I had,
Yeah.
Blake. So could we get, over the next week, trading's going to be thin and so forth. Um, Again, it just comes down to what is the bigger move over the next 6 to 12 months? Is it to the upside or downside? I think from a risk reward basis, it's about 14 to 1 versus to the downside versus upside.
Yeah, I
So,
mean, here's a look at the dollar here, just a live look at the dollar. I mean, it's showing a pretty big reversal today, but
yeah,
you're
you could
thinking
have one
maybe,
more pop. I mean, it's like that pop that we saw because of the Fed and all that could be like wave three of five.
yeah,
We have one, two, three of five. This pullback is four or five, and you get one more push above that 108.54 or whatever it was to complete it. But the point being is we're in an area where one starts to look for, and at the bottom you can see the RSI. I'm pretty sure I can't read that number. Is it below 70?
6601.
Well, think about that. I mean, RSI, we're always momentum indicators looking for a divergence. The idea you throw a ball up at 50 miles an hour, even as it gains altitude, it starts only going up by 30, 20, 10, right?
Yeah,
So that's the RSI. And you can have divergences. Oh, it hit 80 and now it's 77. Well, 77 is a strong number. But my experience has been, Blake, when you get a divergence and it's below 70, those are the more higher quality signals because 66 at a new high is not a strong number. And so all of this stuff combines to suggest over the next 1 to 3 weeks or so, we should be looking for a high to be put in and a reversal. Now, it's not going to fall out of bed overnight because people are bullish and so forth. The first thing would be, okay, a pullback to what, 105, you know?
yeah.
But we'll take it one step of the way. But from a bigger picture standpoint, a top in the dollar over the next month, I think, is going to be important for a lot of
Well,
markets.
all right, Jim. Well, you talked about this top in the dollar. That means that gold should be near some really key support here.
It's holding. I still believe, Blake, we're going to see a decline below 25.41 before the correction that started a month or so ago is complete. Um, you know, this is, I believe, wave four from the September 22 low, and wave two lasted 4 months. So waves twos and fours often have at least an appearance of being relatively close in terms of time, and that would imply February, March. So again, I think my take is gold's going to drop below 25.41. If and when that happens, that will probably be a buying opportunity for at least a short-term trade because I just think this is going to stretch out in time. So we've held that support line that's drawn there, getting a bounce, but I think the odds are positioning is still pretty heavy and towards long gold. I think sentiment is still pretty positive. So I think gold's going to have to decline a little bit more before I'm going to be really interested in buying it.
All right. Well, that's it. It may or maybe this is it, Jim. Maybe this is it. Well, the
Yeah.
next chart you brought is TLT. So you've
Yep.
been looking for this to turn higher for a while. Is this going
And
to
I've
be
been
it?
wrong. I've been wrong. I mean, I thought that the rally from 89.42 it got up to 94.85, I think, and I thought we'd have a pullback. But this pullback, obviously going to a lower low, was not what I was expecting. But you can see that the low we saw yesterday is pennies away from the low that we saw in April. So I think this is an incredibly important level for TLT and thus treasury yields to hold. If it takes that out, then I think we're going to see Treasury yields spike even more. If I'm right about the dollar, if I'm right about the economic stuff that we talked about, that we're going to get progressively better inflation data as we get further into next year, the economy is not going to be as strong and so forth. Um, I think TLT is going to hold this, and we have the potential for another rally back up towards 100. But right now, I'm from Missouri. You got to show me something. So at a minimum, given the velocity of the decline that we've seen over the last 2 weeks, it's pretty, I mean, it's very strong selling, high selling pressure. And the risk here is that the perception of deficits, getting that all under control, is making people pretty squeamish, in terms of, do I want to step in and buy long-term bonds when we have no idea what's going to happen with the new Trump administration? Is the deficit going to blow out even more? Um, I think those fears are maybe overblown in the near term. I mean, if you got a Treasury Secretary that wants to cut the deficit from 6.4 down to 3, that sounds like somebody's got his eye on the problem.
Yeah.
But we'll see. I mean, I get the other side of the equation. So I still think there's the potential for a very meaningful rally in Treasury bond prices, yields coming down, and a rally in TLT. But right now, I'm like standing aside because A, I was wrong. The pullback, I anticipated a pullback. It went further than I thought.
All right, Jim. Well, with all that being said, the last thing you brought is the S&P. I mean, we've seen a lot of volatility here. What do you make of it?
Well, last week I said, as long as we hold 58.33, we got a new high coming. And what was the low today? 58.33. And it was just look at the channel that the S&P has been in, and we came down and tagged that channel line. So the quality of this rally is very important, Blake, because the advanced decline line significantly weakened over the last 3 to 4 weeks. And so if we go up very quickly, or the S&P goes up very quickly to a new high, a marginal new high, uh, there's a chance that we'll see, for the first time in some time, a meaningful divergence between the S&P and the 80 line. And most of the important tops going back to 1928 have been attended by new highs in the S&P in the advanced decline line, not confirming it, either then being followed by 10 to 15% corrections, or, like we saw in 2007, 57%, uh, uh, 50% in 2000, 73, 74 was what, 50%, 87 to crash. I mean, this could be a big deal. So, but it's not in place yet.
Yeah, it's not. And the question is, I mean, everybody's kind of brushing off what's happening in the as far as the government shutdown right now, but it doesn't mean that that won't have an effect on the market in the next week.
Yeah, in the very short term. I think uh, what's his name? Tesla man, Musk.
Elon
I think
Musk.
he made a yeah, he made a comment about, well, there could be some short-term pain. Again, to accomplish what they want to accomplish. And I think one of the primary goals is we can't keep running these huge deficits. The interest expense will eat us alive. They are correct in those statements. So I think that's their focus. But in order to accomplish that, you might have to have a little pain. If you go, as I said, you go from 2 trillion in spending deficit down to 1 trillion, that means you're spending $1 trillion less. That's going to have an economic repercussion that's going to result in slowdown. You know, and I think as people start to process and understand that that's what they're talking about, um, there's, to me, the reaction is that bonds could rally and the stock market could be vulnerable. Because right
Well,
now, everyone's looking for the economy, which is in good shape, to get even better.
right, right. Well, yeah, that's what everybody's looking for right now, and and everybody's got high hopes, like we talked about. So
Yeah.
So the question is the market going to be able to, is Trump going to be able to live up to those expectations? And it looks like we're fixing to find out, right, Jim?
Yeah, we will. And again, I think the expectations are somewhat disconnected in terms of the reality he's going to be facing as he goes through all these negotiations regarding trade. Again, Washington, the Democrats are going to fight everything he does.
Right.
And there are some Republicans that are going to want to exert some leverage because they can. You have a 3 or 4 seated majority in the House. So, like I said before, this budget stuff that we're seeing right now, I think is kind of like, whoa, okay, maybe everything isn't just going to sail through.
Right.
So, you know,
Well,
and how will markets react if all these expectations, at least at some point in time, aren't met?
yeah.
There's going to be a correction. They're going to give back some of the gains in terms of the S&P, and I think the dollar gives back some of its strength.
Well, Jim, one of the other things that just thinking about everything that you're saying here, you talk about like kind of Trump's his he gave a lot of proposals like over this week regarding the stopgap bills and his proposals,
Hmm.
and a lot of Republicans rejected it.
Yeah.
So
No, I mean, again, I've been saying this. This is what's coming. You
yeah,
know, it's not going to be just smooth sailing. I mean, if you're going to be a disruptor, there are vested interests, in this case, in the government, both in terms of public servants, in terms of the Democratic Party, some Republicans, they're going to resist you. It's not going to be a layup. I mean, again, he won convincingly. It was not, in my view, a landslide. If it was a landslide, he'd have like a plurality of 30 seats in the House. He's got 3 right now.
yeah,
You know what I mean? And the idea of the trade negotiations. Okay. Well, Canada said, well, maybe we won't send you any energy. And so those people in Maine and Michigan and Wisconsin, I think it was 1.5 million people had their houses heated from energy coming from Canada.
wow,
They're not going to take this stuff laying down.
yeah,
And just like Trump wants to position prior to negotiations, they're going to do the same thing. And so the negotiations are going to be bumpy. At some point in time, with some countries, it's going to be, well, they walked out.
right.
Right now, there's no additional conferences scheduled. I mean, that's what's coming because that's the way it is. So we'll see.
Well, Jim, I want to say thank you for this whole year for giving us your views and guiding us through the markets. And I want to wish you a Merry Christmas to your family and also to our viewers that are listening to us
Yep.
out there and are religiously listening to your commentary. What's the best way for traders to follow your work, Jim?
Well, first of all, I was remiss in not wishing you a Merry Christmas, and obviously the folks that are nice enough to tune in and to listen to us babble on every week. Thank you for doing that. And 2025 is going to be a very interesting year, and I hope it brings most people good health and we'll do our best to help people navigate it. So macrotides.com. If you want to receive a recent report, Jim Welsh Macro at Gmail.
Well, Jim, like I said, I appreciate you, and I know everybody else does out there. Make sure you jump in the comments below and tell Jim how much you do appreciate his commentary each and every week. He provides us exclusively here on Trader Summit, so make sure you do subscribe to the channel. Jim, thank you so much, and we'll catch you on the flip side. And as a matter of fact, I don't know if we're gonna do an interview next week, or probably just after the
Why
new
not?
year.
Friday.
Huh?
It's old habits, guy. If Friday, if I get up on Friday and I'm not doing a conversation with you, I'm gonna like, what day is it?
All
I mean,
right,
I'll
I'll
be,
be around. So maybe
yeah,
we'll
me
catch up with
too.
you, and maybe Jim will give you some ideas going into 2025. So be around for that. Merry Christmas, happy holidays, happy Hanukkah. It actually drops on the same day as
Yeah,
Christmas this year. So happy
very
holidays to
unusual.
all of you that are celebrating whatever holiday you're celebrating.
You got it.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.